Good morning. It is 30 minutes before the stock market opens on a Monday, and it would be good to have a live stream here and just talk about where the market is headed toward on this open. My name is Victor with Victor H Investing, coming to you on stocks, and just wanted to cover stocks that I think are interesting to cover today. And viewer requests are encouraged. If there's a stock that you want me to talk about, please put it in the chat. We'll take a look at it. I'm going to go a little deep today on some companies. I'm going to go through my full model that I've created on an Excel spreadsheet that looks at cash flows for a company, looks at earnings per share. Then I determine what I think that company is worth and compare it to the current stock price to see if it's discounted. So if you have a stock out there that you want me to take a look at, please put it in the chat. And I may take it all the way, crack open the financial statements and see what's inside and see if that company is discounted and is a really good opportunity, or if it's priced at a severe premium and it'd be a stock that I would pass on. But if there's any stock out there that you're interested in taking a look at, please put it in the chat. Be happy to take it into account. I've got a few stocks that I wanted to look at, a couple of them in the oil complex. Over the weekend, we had a little bit of tension increase in Israel and trying to go after Hezbollah. There was also a production halt in Libya, which those two things to the oil markets caused a 3% rise in the price of oil. When oil prices go up, oil company stocks go up. So I've got a pretty big position in Chevron. I own roughly about $120,000 of Chevron. So I watch oil prices with that respect. What I have noticed is oil prices in 2024, for the most part, have been controlled, or have been not necessarily low, but moderate to a little bit low. And I think there's an opportunity to look at maybe some small caps within the oil complex. So I'm going to look at two small caps within the oil complex to see if there's opportunity there, if there's value that I could tap into. So I'll take a look at a couple of oil stocks. One of them, Petro, the other one being Noble. They're both services companies. I'll look at Chevron, which is a fully integrated energy company. They're a big oil company. You may notice their gas stations when you drive around and gas up. So I'll take a look at those companies. Again, if you have a stock you want to take a look at, please put it in the chat. We'll take a look at it because it's fun when viewers have a stock that they think is a good idea right now. I'd love to take a look at it. I get value out of that, and I hope I add value back by looking at it and doing a full analysis. Looking at the economic calendar, we did have some economic news today already at 5:30, which is the durable goods orders. So durable goods being, large purchases, and it went up substantially, 9.9%. So that's good news for industrial stocks that are selling, bigger ticket items. So that's kind of good news today. I know that there's talk that we're going to go into recession, but I continue to think that, yeah, maybe we do go into a recession, but it's not going to be so bad. And there's some bit of good economic news that reinforces my feeling that, yeah, we may have a recession, but it shouldn't be terrible. It might be just a slowdown. Additional news this week. Tomorrow, I'm also a real estate investor, so I like to keep track of the S&P Case-Shiller report. And this is a very good report. It just tells you where the real estate market is, what trends are occurring, and we continue to see real estate prices go up. But I have an expectation that at some point, real estate prices will begin to go down. They've been going up substantially year over year, especially after COVID. For some reason, after COVID, the inventory got real tight and prices really went up. They actually have been much higher than they have been historically. I think there's going to be a reckoning in real estate where you see prices come down. When they do go down, I would love to buy some more properties. So I'm watching that carefully. So that's the other report that we're going to see this week is GDP on Thursday. And GDP is the measure of our overall economy. And if it continues to grow, it'll be good news. It looks like the consensus GDP growth rate year over year, the consensus is 2.8%. It was previously at 1.4, which is a little bit slow. We'll see if it comes in at 2.8. If this were to fall, let's say it fell below 2%, it would signal that, hey, we're slowing down. 2.8 is pretty decent. It's not great, but it's pretty decent. If you grow at 3%, your economy is doing fine. If you grow more than 3%, it's deemed to be your economy is booming, especially if you get like China would grow at 6%. They'd grow substantially. And it was a high growth economy for a while. They've toned down their growth rate, but overall, they're still a growth market. So this will be an interesting report that I'm going to keep an eye on. And I think Fridays are usually pretty chill. Yeah, nothing big. The Michigan reports, these do get looked at, but it's going to be on a Friday. I think on a Friday, people are eager to get out of the office. And especially, I think we have a weekend, a 3-day weekend. Yeah, we have Monday off next week. And so I'm going to take the day off. I'm probably not going to live stream. But next Monday is Labor Day. So the stock market will not be open and we will only trade 4 days next week. But this day, it's 5 days. Looking at where the market has traded for the month, it's been a good month overall. It's been an active month. Holy smokes, man. You had stocks really fall, and then they got up off the mat and picked up. And overall, my portfolio has gone up nicely. When we started the month, I mean, the first 3 days of August were quite brutal. I was down 5%. And I just thought, okay, been here before. It's probably going to be a terrible month. It'll be like, pretty substantial losses this month because the first 3 days are a signal of what's going to happen. It's just going to be a really brutal month. But it ended up being, hey, it picked up, and now I'm sitting on a really nice gain for the month of August. I'll take it. My birthday is on August 20th. So, hey, stock market decided, hey, man, we're going to have an up month, I guess. But I guess I'm probably speaking too early. We got 5 days of trading, and all my gains can be taken away in 5 days easily. It seems that stocks, the term is that stocks go up the escalator nice and slow, and they go down the elevator nice and fast. So we can lose all my gains, or I could lose all my gains in a matter of 2-3 bad trading days. So I better not celebrate too early. So that's where we're at with the stock market. It looks like the futures are going to open pretty much flat. We'll see where they go. I usually don't trade in the first 30 minutes. I might have something that I want to do. I do trade bonds because bonds tend to be, I think, priced ahead of the market, the stock market. And I might put some buy orders on bonds. But stocks, I like to see what, especially on a Monday, I like to see, what's the market doing? Is the market going to sell off? Is it going to rally? Are there some big stories out there that I should take into account? So I try to stay away from trading in the first 30 minutes and try to see what the market's going to do. I like to dollar cost average my investment in companies because I'm just not good enough to tell you the exact point where a stock's going to hit a bottom. I'm not exactly sure, not certain when it's going to hit a top, but I do know when a stock is discounted, and I like to buy when stocks are discounted, preferably on pullbacks. And I do use options, but not a whole lot. I like to keep it as simple as possible and invest. Preferably, I like to hold stocks, for a long time. My biggest position is Meta, and it's got there because it's appreciated so much. Second biggest position is Google, Alphabet. It's grown nicely, but I got some big bets at smaller companies like Uber, Airbnb. Robinhood's done great. Coinbase has done phenomenally. I also own cryptocurrencies, which have done great. And I know they're kind of a weird investment for stock investors, especially older dudes like me. But I've done a lot of homework on crypto. I've started really doing my homework around I'm going to call it 2015. And at that time, I thought they were a neat idea. And I'm out of the technology industry, so I totally get that we were completely digitized. So having a digital cryptocurrency made a lot of sense. I started investing in 2018, and it's been really good. It's been, ups and downs, as you would expect with a new market. But overall, my crypto portfolio, which I would include Coinbase in there, it's outperformed my stock portfolio. I don't have as much invested in that, but hey, gains are gains, and crypto's done quite well. Let's take a look at Asia real quick. So the Nikkei is down 0.66%. And it looks like Hong Kong is up 1%. All right. So that's what's going on with the stock market. All right. So let's get into a conversation around oil and get into some oil companies. So as mentioned, so over, I guess, the weekend, we had more conflict in Israel between Israel and Hezbollah. And hopefully not a lot of people get hurt. It's terrible that you have a conflict. But in that region, right, there's a lot of oil producers, and Iran being one of the big oil producers. And I guess their involvement, if you listen to the news, they, I think, have some involvement in this. I'm not quite sure, but that's what's been reported. And I think that creates tension in the oil market, as well as Libya having a production halt. And what that causes is higher oil prices. So when we look at a big oil company like Chevron, and this is one of my positions, it's up 1% in the pre-market, understandably. And if you follow Chevron and Exxon, oil prices really affect their stock price. if we look at their 1 year, oil prices haven't been overly high. So this stock hasn't done great over the 1 year. What's nice about Chevron is it does pay a dividend. So for those income investors that want a dividend income, oil companies are a pretty good place to be. They also tend to be a, a really good defensive stock. It seems like each recession we go into, it's led by high oil prices. So it's kind of weird that you go into a period of time where a lot of stocks are going down in value or price, and oil companies tend to go up. Example, 2022, I saw my tech stocks really go down in value, and our friends at Chevron decided, hey, we're going to go up 60% in value. So it is a hedge against kind of like all the other stocks that I own. So that's one of the nice things about Chevron. So when the news is good, overall, my portfolio does awesome. My tech stocks go up in value, double thumbs up. When the news is bad, it's kind of like, okay, well, that sucks for most of my stocks, but Chevron tends to rally really well. So I like having that as the hedge against everything else. Now, this is a big oil company. If you look at my valuation, of, so if we look at, uh, and sorry, 1 second, I'm getting a feedback on my sound. Give me a second. Right, let's keep rolling. Um, so we have, I'm going to do Noble Energy in a few minutes. Now, what I'm going to take a look at right now is just Chevron, and I think I have them here handy. Let me look them up. Chevron. This is my valuation spreadsheet. And what I've done is I've modeled based on the ways to discount a company or value a company based on cash flows. And I've created this spreadsheet. I've read books. I've understand mathematics quite well. I have a master's in business. Really love modeling and data. I also have an accounting degree. Worked in public accounting and so forth. But really is I really like how the YouTube era of investing has provided examples because I was able to view some channels that I really like Scott's Due Diligence. I mean, I owe Scott so much because I've probably watched 1,000 of his videos, and he's a very uh, uh, disciplined investor with regards to his analysis. So um, I really appreciate how he does his analysis, but this is my analysis. I created my own spreadsheet, and it starts with free cash flows. Free cash flows is the principal method that most investors, long-term investors, rely on. So if you look at the late great Charlie Munger, he loved free cash flow. That was his determining factor of the value of a business. If you look at the top 10 most valuable companies on the stock exchange, look at their free cash flows, and you will see that free cash flow is the method that those companies have achieved really high valuations. So I use free cash flows. And Chevron really produces very good cash flows. They already own, the reserves that they tap into, extract oil, put it into the market. They also are fully integrated. So they have refineries that refine crude oil and put it into a petroleum product that can be used, like gasoline, diesel, lubricants, and so forth. Even fertilizers come out of natural gas. And all those things create really good cash because these are mature businesses that are almost they are an oligopoly to put it out. The oil business is if you wanted to start an oil company, it's impossible. It would be impossible for you. There's probably really two major oil companies in the U.S. And that would be Chevron, Exxon. After that, there's probably some middle of the road players. But after that, it's really hard to start a oil company. So this is an oligopoly kind of like industry. And these guys, their cash flows will be protected. So they have very good cash flows. And I think the intrinsic value of the cash flows is $500 billion. And I add cash, take away. I think Chevron, the equity value is $489 billion. And the market cap not quite up there, so it really has a really nice discount on their share price. Now, their price tends to move with oil. If oil goes up, the price will go up. My valuation has more stability. I'm not moving my valuation based on oil price. No, I'm really basing it on historical trends, historical data, and saying, "Hey, this is what I expect over the next 4 years." I can't predict oil prices. Nobody can. What I can do is do a very good analysis and have a forecast that I can depend on and I can invest on. So that's what I use. Growth of 6%, nice and low, nice and modest, and then growth of 4%. So Chevron's discounted. They're also, if you look at the earnings per share, this one's easier, simpler mathematics. I like to look at earnings per share, but I put more weight on the free cash flow because that is a method that reveals the best value, especially in a mature company. You have a younger company, it's not quite, you know, producing a lot of free cash flows. That's why I keep earnings per share, is if you have a young company that's not producing free cash flow, they still may be super valuable, so I still wanna look at them and potentially invest in them. Good example would be like Uber. I invested before they had great cash flows. I saw it coming. I kinda thought, "Hey, they're gonna get to a free cash flow stage," and I value them, I think correctly. I'm up on the stock really nicely, and I've owned them for a while. So Pump is, so that was Chevron, and Chevron for me, I'm holding my shares, I'm not buying anymore just because I own a substantial amount, a little over $120,000, so I want my portfolio to be, you know, concentrated in just a few stocks, although the 3 most concentrated stocks that I have, I'm totally comfortable with. That would be Meta, Google, Chevron, but then there's a pack of stocks right behind these that, are really good. So, ProPetro, this idea came out of I host an investor call and, um, there's an investor, I gotta tip my hat to him, official tip to, this guy Brian. He brings ideas that just damn good. He brought a really good idea last weekend. This weekend, he brought up ProPetro, and he really liked the company. This company basically is in you understand the oil business, there's fracking in the Permian Basin in the United States, and they found reserves there, but you have to frack them. You have to frack in like Pennsylvania, you have to frack in California, all kinds of different places, and it's the method of extracting the oil that's really difficult to extract. Takes all this machinery, know-how, and it's expensive. But when you have oil prices above $60 per barrel, this industry tends to be profitable, and we're north of $60 a barrel. So ProPetro might be a good idea. Their stock price is down, and it's been down because of oil prices being low. But this is such a tiny company, less than 1 billion in market cap. You're buying the company for less than their sales amount, which is interesting and looks good. The PE is 26, forward P is 19. Analysts really like the company. They're like, "Hey, it's a buy and it's discounted severely." I look at their growth rates, very good growth rates, and I'll point out that even though we have down oil prices, really their loss of sales, loss of revenue isn't all that bad compared to others like Chevron. So I really like where this company is being operated, re retaining their revenues even though you have bad oil prices, and overall, their cash flow is good. If we look at their cash flow, um, their free cash flow is $148 million trailing 12 months. 148, keep that number top of your head. You go to their market cap's 843. So just doing some quick math, I mean, they're up there, 17% yield of free cash flow on market cap. That's very good. That's excellent. So when I put a company like Pump into my valuation model, it really reveals a nice discount of 48%. What I do with small businesses, I forgot to cover discount rate. So I do my forecast of free cash flow, right? Okay. Pump is producing 100 and rounded up $149 million of free cash flow trailing 12 months. And it isn't going to be a demand decrease. I know that EVs are great, but it was just a necessity. So I expect it to grow and to grow at 5% over the next 4 years, which is modest. These guys are tiny. They can grow at 20%. Nobody will notice because they're tiny. And long-term growth, 3%. Nice and conservative. And the discount rate is 12 because it's a smaller company. I used 8 with Chevron because it's an established company, lower risk, great balance sheet. Everybody knows Chevron. They ain't going nowhere. But Pump is a smaller business. If they were to have a catastrophic event, let's say their equipment caused a big problem and they were, taken to task by a government or they were sued, big time, that could really derail the company and maybe bankrupt them. Who knows? They're a smaller company, so there's risk. So I put a higher discount rate. You can think of discount as the rate of return that I want. And the finance philosophy is the more risk I take, the greater return I want. If I take no risk, I expect the return will be low. If I take more risk, the return will be higher. Okay. With a smaller company, I'm taking a higher risk. So I want a higher rate of return. I'm going to discount all those free cash flows that I expect the companies to produce by a higher rate of return or discount rate to get to a net present value of all those cash flows. This is this is the core of valuing companies based on free cash flow is in this box. I like to add cash and take away debt, which is might be a little different than what other investors do. The reason for it is sometimes you have a company that looks great on the free cash flow model, but they have a lot of debt, and you're like, well, that's got to be a decrement to overall value because it's almost like if you take away the debt, which is key, it really does reveal the net value of the company. In this case here, I call it equity value, 1.5 billion, but the market cap's only 844. So it's a big discount based on free cash flows. This is a young company. This where I should say, where the business is a young company. Oil companies tend to be like 100 years old. These guys are not 100 years old. They're more of a new generation company. So this has been a really neat idea. I've got. I'm gonna. And FYI, I provide no financial advice. I don't recommend you buy, hold, or sell any stock that I ever cover. I just share my experience and my plans on stock. My plan is to buy into pump. I think I'm gonna sell a little of my Chevron and buy some pump. Maybe about $5,000 as an investment because I think that this has a lot of good upside, and I think Chevron's awesome. I've had Chevron for a long time, so that isn't going anywhere. But I'm gonna reduce a little bit of the Chevron position and put some money into pump. All right, so let's get our hands dirty here. I'm gonna go into Noble Energy, which is right in this industry, and I'm gonna fill this guy out with you on the live stream. So, Noble Energy is a company that does offshore drilling. They're a contractor. They're different than Pump that we just talked about, but they are in the same oil complex. They just do it offshore drilling, which is quite quite popular in this industry. And they are a $5 billion company. You're buying 2 times revenue. PE is really low. Forward PE is really low. Analysts are saying, "Hey, it's really discounted, 50% discount." Wow, so that looks really interesting. You can see that they're growing the revenues really nicely. That's really good growth. I don't care what industry. You can see when you have, this is now. I give a pass to all companies in the COVID year, and especially oil companies, because if you recall, like we went from normal to hey, everybody go home, don't drive to the office. Uh, Buses weren't really occupied with passengers. You just go down the list. Airlines were not flying as many flights, and just go down the list. So I don't treat this as like, Noble didn't do anything. The world did something. So after that, they still had a bad year 21, but after that, holy smokes, they've been prepared. So that was pretty interesting. And again, their stock price, although it went up because they started rocking, growing at 70%, it's really come down since I'm gonna call it fall of 23. Stock's down quite a bit. See how far down it's come down. So if we go we look at the annual, right, from the peak to where we're at now, the stock's down close to 30%. So it might be a neat little opportunity to pick up Noble shares, but let's value the company first. All right, so stock price has been discounted recently. That's interesting. We saw that they're growing their revenue. Cash flows are good. Let's start getting the data that we need. So cash flow, trailing 12 months, $113 million for the trailing 12 months. So let's put that in our spreadsheet. These guys, I'm going to leave the growth rates that I had with Pump. Now these guys are a little bigger, so I'm going to come down on the discount rate, maybe go to 10%. Noble is a more recognized company in their industry. And so based on that, now we're gonna look for cash. What is the cash position for this company, and that's on the balance sheet. Now, cash and short-term investments, they have 162 billion. How much debt? Let's see how much debt we got. Total debt, 622 million. I'm also gonna look at a ratio on debt. I want debt to be less than 3 times their EBITDA amount. Do that in a minute. So the cash flows are worth 1.1 billion, which is kind of low. Let me look at something before we move off of their financials. I'm going to look at their historical cash flow. You can see that historically they haven't really been much higher than 113 million. So that number is good. I'm good with that number. Okay. So cash flows are lower than expected. It's a $5 billion company. So the market cap is $5 billion, $420 million. They have 142 million shares outstanding. So each share, based on free cash flows, is worth $7.87. This stock's being priced at a premium 80% if you look at their free cash flows and you look at a forecast free cash flows and you expect all these cash flows are gonna be generated. And if you look at their historical data, it's pretty consistent. Now, why is there a big difference between Noble and Chevron? Well, the most profitable space within an oil company is the companies that own the reserve, the land, or the rights to drill in a particular region to extract that oil. That's why Saudi Arabia is so wealthy, is their oil tends to be very good quality, like sweet oil, which is almost looks like honey, and they have a lot of it, and they own those reserves in their country. Nobody can go in there and tap into them. It's also a nationalized industry, so that's why those guys are got a lot of money. They've got a lot of oil. Chevron owns the rights to drill into oil. Noble doesn't have that as part of their business. They're just a services business. They have to go out and do the work of drilling and setting up platforms for these oil companies. So it's not quite as profitable. So we can see that they're less desirable than an oil company that owns the rights to the oil fields. All right, so we went over free cash flows. Let's take a look at earnings per share now for Noble. And I do like this little stock analysis website, by the way. And I get nothing from them. I think it's a really small and interact with, I think, the owner. And he's a nice guy. They put together what I like this website because it gives me everything I need, and I never see one ad. Thank you very much. I hate like CNBC that puts like 100 ads in front of me. It's quite distracting. So 5 analysts cover Noble. And they say, "Hey, this stock's really good. It's discounted big time." And they base it probably on earnings per share. Earnings per share is $3.24. They're expecting it to really rise next year, and then after that come down. And this business isn't quite pegged on oil prices. It's probably, um, pegged on just the forecast or the book of business that they have, contracts if they signed. There's probably a pretty good lead time, right? Chevron calls these guys and says, "Hey, I want you to set up this oil platform in the middle of the Gulf of Mexico." And they're like, "That's fine, but we can't get to it for like another year." Okay, so they get on this. All right, so $3.24, pretty significant growth. So I'm gonna put it at 324. I always hate, going too high on my and PE. What PE would I go with? This is a growing business. It's good. I'm gonna go with 18. I'm gonna go with a 24 growth rate. You can see that, yeah, using earnings per share, it's 87% discount, but I take more of the free cash flow method to the equation, 2/3 free cash flow, and then 1/3 earnings per share. So overall, for my investing decision, I think Noble Energy is being priced at a premium of 24%. It's great that they're gonna do all this earnings per share, but cash is king. Cash is the way that a business is truly valued. And this is an established business. It's not like Noble started a few years ago, so I could kind of ignore free cash flows and just base it on earnings per share. That's not the case. So Noble is gonna receive a pass from me. I don't own any shares, so no need to own any shares because it's not a desirable investment to me. So that is my decision on Noble. So hopefully you guys thought that was interesting. Happy to take on questions, and again, happy to look at stocks that you want me to look at. I got a couple more that are up my sleeve, but, if there's a stock you wanna look at, please let me know. All right, market's been open for about 6 minutes. What's going on? Stock market. So Dow is up a bit, S&P's flat, looks like it just reset, so S&P's up. Nasdaq is up a slight amount. Look at the wow, the Russell, rock and roll, baby, up 3%. These are smaller companies. The Russell's really lagged the the big caps. Not a big surprise to anybody. The big caps have just been killing it. So, uh, NVIDIA being the biggest killer. And then Microsoft, Apple, all those big giant companies have just been killing it. But these small caps have been left behind. So it's good to see small caps really do something. I'm buying more small caps. The 2 areas that I think are gonna do well for the next 12 to 24 months that I think are gonna receive more of my capital, smaller caps and healthcare stocks. So that's Boss Haas wants to look at AAL. So we're gonna look at that next. So AAL. You just finished my thought on small caps, and then we'll get to that. So if you look at small caps, right, 18%, that's pretty good. But let's compare it to the NASDAQ. Nasdaq's up 30%. So the Russell hasn't kept up with the Nasdaq. It had a really nice period here, like at the beginning of July when interest rates were deemed to be going down. It really caused a significant rally in small caps. Then they faded hard, and now they've been keeping up with the Nasdaq, so to speak. But overall, you could see these guys probably have better valuations, better fundamentals. And that's what I'm finding. I showed you our friends at Pro Petro, tiny company. The PE is reasonable, strong buy. I think it's a good investment for me, so I'm gonna buy shares. So that's what we're talking about when we talk about the Russell, and I think this is gonna be where I find probably a couple good little investments. I started investing in Robinhood when they were really undesirable to the market, but desirable to me, and it's really paid off. Coinbase is now substantially bigger, but nobody believed in Coinbase, it seemed, and bought shares at Coinbase, and thank you very much, stock market. I've had a really nice return. So it could work, but you got to be careful with small caps. They're riskier, less known companies, right? We know what Microsoft is. We know they've been around for 40 plus years. We know they have franchises of businesses that are going to be around for the next 50 years, I imagine. And but these small caps is like, hey, they didn't exist 10 years ago. Their business became profitable 2, 3 years ago. Okay. And where do they play? Do they have more risk? They do. So I like to use higher discount rates. I like to really make sure that my rate of return is going to be higher on small caps because if I buy into 4 small caps, I would not be completely surprised if one of them is a complete loser, one of them is an absolute winner, and then a couple of them are in between. I'm okay with that. If I find an awesome winner, what I tend to do is I invest in 4 companies, right? I track my stocks every quarter. I analyze them twice a quarter. I keep up with their news, keep up with their businesses. If I see a business is really working, United Therapeutics is a good example. I keep pouring capital into United Therapeutics. Healthcare, small cap, rocking and rolling, growing their business. They have a great business. I keep putting capital into those types of businesses. So it's good to see that the Russell is getting it done today. Very good news. All right, so we have a request from Boss Hoss. Let's take a look at AAL. So this is American Airlines. So I owned United Airlines for some time, and in general, I made money, but I could just tell you that I was pretty surprised. Um, and I'll tell you the quick story of United, and then we're going to analyze American completely. We're going to go through evaluation and everything. So back here, when we had COVID, right, the airlines were propped up by the government because, frankly, if they wouldn't have done that, they would have all been bankrupt. There's no way they could have gotten through just a year, 2 years where nobody was flying. And the government told people, "Do not fly. We don't want you to fly on airplanes because you're gonna infect more people with COVID." Got it. Okay. Now, I bought into United in this era thinking, "Well, this isn't gonna last forever." And understanding human nature, everybody's gonna wanna travel here, and it was the case. Like, I took my wife to Italy here. We traveled to Mexico City. We were traveling because we didn't do anything for, like, a year and a half. I was like, "Oh my god, I'm tired of looking at inside my house." And that was correct. So, it was my business logic was accurate, but the valuations have not been very good, 60% over the last 5 years. If you look at the last year, down 30%. So, as we look at airlines, um, I'm not quite sure, that it's a great investment. I'm out of United, but let's take a look at this one. I just want you to be aware, you know, we get to pick as investors. There's no rule that says, "Hey, Victor, you only get to invest in communication services companies or consumer discretionary." No, I get to invest in any industry, in any stock that is traded on the US stock. There's some limits. I can't invest in other foreign exchanges without it being complicated. But my point being is I have thousands of choices. So I get to pick the industries that I want. And in some cases, just the market does not like airlines, does not like auto companies other than Tesla, does not like certain industries. It just hates them. The PEs are super low. It's incredible how low their PEs are. American's probably going to be one of those. Look at the forward PE, 7.3. Ridiculous. It's in the ridiculous column. Analysts are saying, "Man, it's such a buy, 50%." Okay, we'll take a look at that. If we look at their revenue, look at this growth rate right now. The COVID year, they went from 42 billion in revenue to 15 billion. Most of that was probably government subsidies. So their business tanked 62%, then it rocked, grew 72, 63, grew 7% in 23. And it's, trailing 12 months isn't looking. They have modest growth. Let's take a look at something. So they're a $49 billion company full year 23, which is a lot higher than 2019. So in general, you're getting a bigger airline. Very good. When we look at their cash flow, these airlines are cash flow. This one is not. United is. Cash flow, actually, cash flow looks pretty terrible. Their cash flow looks awful. In 19, it was negative, real negative. Understood. 20. Why aren't they producing more free cash flow? United, I'll open up United just to make sure I'm not crazy here. And I picked United because I thought they had the best valuation, best fundamentals, and their free cash flow is terrible. So what was going through my head when I looked at United? Let's get back to America. So their cash flow isn't good. It's negative. But let's look at the quarterly and see what's going on. What is going on? So free cash flow in the most recent quarter is positive. This quarter was positive. It looks like at the end of 23, they may have reconditioned some airplanes, put some money back into the business. But if you look at the first half of 24, it's quite positive, right? We're up to well north of $1.8 billion. So if I took that times two, 3.6 billion, multiplied that times 10, this is a $36 billion value company. They're only valued at 6 billion. So in the last 6 months, they've generated $1.8 billion of free cash, and their entire market cap is 6.82. Again, going back to doubling that 1.8, we're up to 3.6. 3.6 times 2 is 7.2 billion. They're producing well north of 50% of free cash flow to market cap. That's how much value these airlines are producing, but the market, it just doesn't like airlines. And I think Warren Buffett was an airline investor 30 years ago and then swore them off. He's like, "I'll never buy airlines again." I don't think he's in airlines again. I thought, hey, it's a good investment because everybody thinks they're gonna die and go away. I don't think that. I did make some money on United, and I think I still have United up here. So I did buy when it was super low. I bought and pulled back, so we made some money, but nowhere near what I should have made. I'd rather find the next Meta or the next Robinhood. I don't like sitting on investments like this because, frankly, the 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 stock market taught me a lesson, and I paid for that lesson, which in the form of, a yield, a return that was below market and below my other investments, and the lesson was airlines are undesirable. You may see great fundamentals. You may see, really rich valuations, but the market isn't gonna buy airline stocks. So, there you go, Victor. You know, you paid me in the form of a low return for that lesson. Let's do the valuation. I mean, I think you're seeing the fundamentals are just, fabulous. The balance sheet, I think their balance sheets are a little sketchy because they buy a lot of airplanes. Total debt is 39 billion. What's their EBITDA number? Can they pay that off quickly? EBITDA is 5 billion. Okay. So 39 billion, 5 billion. So it would take them over 7 years if they focus their EBITDA to pay off debt. That's too long. That's a bad balance sheet. If they could pay off debt using EBITDA in less than 3 years, that's a good balance. If you see companies with no debt, that's a very strong balance sheet. And the best, most valuable companies in the world, their balance sheets tend to have a lot of cash, very little or no debt. And that makes them stronger. They can acquire businesses, they can buy back shares, they can do lots of things with that excess cash. They have businesses that produce more cash. That's why Apple's worth so darn much. That's why, follow the valuations and understand why are those businesses so darn valuable, and that's why. Um, when we look at this balance sheet, this is uninvestable to me. Too much debt. Too much debt. They're catching a break in the lower interest rates. With lower interest rates is going to help a company like American because they have so much debt. Now, analysts, we got 14 analysts that cover the stock, and they're saying, "Hey, this business is really discounted." Again, I agree with them from a, I guess, finance, mathematical, point of view. But remember my first comments, which was, "Hey, the fundamentals can look great, but they're just part of an industry that I'm not gonna buy." So that's that. In real estate, there's a term that location. You can have the same structure, 2 different locations. Their prices are very different. You can have these fundamentals. If you had these fundamentals in, semiconductor, this thing would be worth $1 trillion. If you had these fundamentals in, communication services, this thing would be worth, a lot more. But it's an airline, so that's what we got. So it looks like their earnings per share is gonna be 1. I mean, that's not gonna be great. Let's do the full valuation of this guy, and So we did Metro there. I don't think I have it right now, so let's see if I can find use Kroger as an example. And Monday morning, doing analysis. It's gonna be a good week. I like doing analysis. So my mom would say stories about me being a little kid, like 3 years old. I used to get up early and go to my dad's bedside and go through the change in his money in his wallet and count it all and tell my mom how much money he had. Um, and that's who I was as a young whippersnapper, and this is who I am today. All right, so I'm gonna go with a high discount rate because these guys, I told you, they're undesirable. The the market just says, you know what, we don't like everyone. We just don't. And I talked about the $1.8 billion number being for the first half, and I'm gonna use um, first half times two, and I'm gonna try to type correctly here. All right, so that was 1.8 billion times two. And this evaluation just gets really ridiculous really fast. The value, if we look at just reasonable rates of return, right, we're going to go with 3 and 3. The business has shown us that from 19 to 23, they went from 42 billion in revenue to 49 billion. So they keep growing, and that's very expected. But cash was, I forgot how much. So let's go back to their cash. So cash, 8 billion 987 million dollars, and then we're going to go to their total debt, which was too high, 39,447,447. So their equity value is 6.4 billion. Oh, interesting. What's their market cap? 6.84. Oh, wow. That debt has something to do with their valuation. Shares outstanding 656.7. I have a valuation of $9.86 per market was selling stock at. So these guys are fairly priced based on free cash flows. Interesting that we got to it. And I used a high discount rate because of their balance sheet. I still wouldn't buy this company because I just don't like the industry and I don't like the balance sheet. It's fairly priced. If this was like, if they were priced, and again, I tried the United investment, right? Because they were priced like super low. If you look at um, this one wasn't priced much lower, but United was around the same. I thought they were really, and what I was comparing to was before COVID, this was a $90. After COVID, it was a $33. It's like, okay, they just lost 60% of their valuation, but I think the business is gonna come back. So my rationale was correct. My thesis was accurate, but I just didn't understand the market's desirability of business, and that's what led to a return that was not to the standard that I want in my portfolio. I want the stock to double in value at least every 5 years. If it's not on that trajectory, why is it in my portfolio? Like Chevron's in there because it's a hedge. Okay, you get a pass. But everything else gets that type of critique is if you're not set to double every 5 years, what the hell are you doing in my portfolio? And I kinda beat up stocks twice a quarter. I'm not quick trigger, kinda like, "Oh, man, I didn't like what they did today, so I'm gonna sell it." I really try to understand the big picture and see where it's going. I hung on to United for like 3 years, 4 years. No, about 3 years. And I sold it. I'm like, "You know what? This isn't gonna happen." And, chalk it up as I learned from it, and I sold it. Alright, so if we look at earnings per share for American, we're gonna see that, okay, they have earnings per share. We look at no, that's see how United has way better earnings per share. Their earnings per share is $9. Woo-hoo. Sweet cash, profit, baby. And I'm looking at the wrong column. These guys are down here at $1. So, man, just on that, you can see United has more value. We're looking at American. Gotta stay in my lane. $1.03. Obviously, we're not gonna put them with a very high PE, which is over 12. Growth rate, it's expected to grow quite a bit. I believe that because you saw United's numbers. And if you look at that, then they are discounted by 48%. I'm agreeing with analysts who say it's discounted by 50%. But I'm also agreeing with the valuation, which says this company is worth about 7 billion. I think it's worth about 6.5 billion because my valuation based on free cash flows gets me to this number, and my valuation based on earnings per share is with the analyst. This is not a buy for me, it's a pass, and that's how I got there. So, and again, that balance sheet, I don't know that investors focus on the balance sheet enough. The balance sheet's really important. It's almost like, you build a house, you build it on a foundation. You have a bad foundation, you're screwed. You can have the most beautiful house on top of a really bad foundation. You may need to bulldoze that house. You may bring in really good engineers that figure out how to make that house, sustainable, but it's better just make sure the foundation's good, and then the rest of the house looks great. All right, and that balance sheet is the foundation of a company. So keep that in mind. Thanks for asking about American, man. And I'm expressing my analysis, my opinion. I could be wrong. Okay. I'm humble enough to know that, if I'm right most of the time, like 70% of the time, I will continue to make a very good return for my family fund. Very happy with 70% effective rate. 1 out of 10 times, the market's gonna teach me a really good lesson and lose some money. Other times, I'm gonna lose a little bit of money and maybe have a lower return. United was one of those lessons that I paid for. And that you have it there. Quick analysis of American Airlines and I guess the whole airline industry. I'm not gonna invest in the American Airlines or United. I'm not gonna invest in airlines. I guess I should listen to Warren Buffett. Um, he, that dude's 93. He has a lot of wisdom. But I don't invest just strictly on one super investor and, "Hey, everything he does, I'm gonna do." No. I invest based on the outcomes that I want. I invest accordingly. He's buying treasuries, by the way. I have a big bond ladder. I was doing that on my own. I've been a bond, investor for quite a while. Part of the reason why I invested in bonds is the bond king, that was Bill Gross. I'm in Southern California, in Orange County, California, and Bill Gross he's from Southern California. He set up his, firm in Newport Beach, PIMCO, Pacific Investment Management, and he was the guy. Nobody came close to Bill Gross when it comes to bonds. So when he was making bonds work and almost compete against stocks in the mid '80s up until probably the mid '90s, late '90s, I really was a fan of Bill Gross. So having said that, I was completely out of bonds, especially 5 years ago, 4 years ago. Interest rates were, like, near 0. Like, "No, thanks. I don't want a 0 return. I want a reasonable return. I'd rather be in cash than have bonds." But when bond yields began to explode, I got really serious about bonds. Some of my bonds are yielding 12%. A very good return on a bond, but I put the time into it. I know this is a stock live stream, but I'm sure every stock investor has other investments. If anything, principal residence in real estate, you have cash, that's kind of a passive decision, but you keep it in cash and you earn a yield. As you get older, as I get older, bonds become an important part of my portfolio that I can create a really good yield. And, if you visit my channel, you see that I've, um, taken the 5 future years of my living expenses and took them off the table in the form of I have a bond ladder that's gonna cover my living expenses for 5 years. Now, each year that passes, I really don't need the money, so I just put it back in. But should the time come, let's say we had a huge market crash, I got the next 5 years covered. I have 5 years to figure it out. We have a really down market for 2 years. I'll be really glad to have that bond ladder, and that's why you have bonds. That's why we have hedge stocks like Chevron. Is yeah, it's great to see tech stocks do so great. I hope they keep going up, and I'll keep ringing the cash register. Thank you, stock market, but they're not. There's gonna come a time when 2022 is gonna repeat. Hopefully, 2007 doesn't. That was brutal. The Great Recession was brutal on stocks, but stocks will not go up forever. They will go up and reward investors that made decisions 2 years ago and have let their, investments compound or made a decision 10 years ago and so forth. But it's really hard to jump into a market. "Hey, the market's turning, everybody." What the heck, man? Somebody tripped on the power cord and unplugged that good market we had a minute ago. But stocks are down a little bit more. Back to, yeah, so as we manage, our investments, and speaking for myself, well, this is beautiful. Thank you, stock market. From here to here, got no complaints. Thank you very much. I like making that kind of money on my stocks, from my real estate. Thank you. But the market is gonna, you know, make us take some medicine from time to time. The Nasdaq is down 35% in the course of more than a year there. So you remember, I hope everybody remembers this. So this was brutal, but it was a great time to invest. But it was brutal, right? Darn, I hate looking at my month-end statements. I measure performance every month. And you're like, man, I took a haircut, a pretty good one, man. And it just kept going down. But this was when really great companies, NVIDIA, Microsoft, just you name 'em, especially the small caps, were just so discounted. And then they got on this run, 70%. The Nasdaq is up more than 70% in less than 2 years. So at some point, we will see this reoccur. Now, I don't invest getting ready. I'm not like a prepper, like, "Oh my god, it's gonna be so bad. I'm a bull. I'm a perma bull, or bear, excuse me. That's the wrong term. I'm just, really, um, uh, pessimistic because the rise has just been too great. No, this thing could go for another year, 2 years, but if it goes at this rate of appreciation, we will have a significant correction. We will. We had one just a month ago where we took some medicine. The Nasdaq was down more than 10%. And the Nasdaq has really come back, and the last month, it's said, "Hey, yeah, I get it. We're gonna go down, but F you, stock market. We're gonna go up just as much." So, it was, like, incredible how fast the stock market went down and how quickly it came back up. The Nasdaq is down, it looks like 0.25%. I like taking a peek at, sectors and seeing what sectors are down, what sectors are up. So, energy, we were talking about energy today, right? Because oil prices are up, so energy is leading the pack. Materials, remember how I talked about that economic report saying durable goods were better than expected? Well, they're gonna need materials to build those durable goods. This is a safe stock, utilities, industrials, okay. Bottom stack, consumer discretionary. So as we have the threat of recession, these consumer discretionary companies might find it hard to sell their premium products. Technology is down a bit. Healthcare is down. That's a little bit of a but not down by much. That's what's going on in the stock market. All right, so that's what's going on there. Let me take a look at crypto. Down, Bitcoin's down. Each market's probably closed. Okay, so let's take a look at one more stock that I've got up my sleeve, and this is a stock that was, a little bit of a shocker, and it was Dexcom. Anybody cover Dexcom? These guys, were a business that started a med device company that helps people with diabetes that have to manage their diabetes, get their blood sugar level and insulin levels. So they created these devices that really improve the quality of life for a lot of people because a lot of people suffer from diabetes. So their addressable market was really big. Now, what happened to Dexcom not too long ago is their stock fell off a cliff. Oh my God. And one day it went down 42%. So I saw an article today that jogged my memory. Dexcom launches first over the counter continuous glucose monitoring. Here's what it's like. I'm like, well, that could really open up the market to them and they can grow their revenue. Now they got hammered, right? They got hammered. Oh my God. So I'm like, well, is this maybe a stock that the market overreacted and punished a little too much? Maybe. They're still up 72% in the last 5 years because for a while, I mean, this stock was working for investors. You look at the run for 2 years leading up to 2022, up 338%. Cha-ching, baby. Ever since that high, it's down. If you would have stayed in the stock, it'd be down 53% over the last, 2 years. So this might be an interesting stock to take a close look at it, see is there value here, right? It's in the healthcare industry. This is med device. It's kind of like tech meets healthcare. You're using technology to help, with somebody's condition. In this case, it's diabetes, and help them manage that diabetes and have a better, life. So so we know what they do, and they're headquartered down in San Diego. They're a global business, opening up their business in different markets. The revenue is close to 4,000,000,000, and the company is valued at close to 30,000,000,000. They have a P of 46, or P of 40. Analysts say, "Man, it's really discounted." Okay, well, let's take a look. Revenue, man, a lot of green on the screen. A lot of green, baby. Woohoo! I like seeing green. I like seeing growth. That's some pretty good growth. Wow. Why did the market discount these guys by 42% in one day? That is a mystery. You guys have tuned in to the Stock Mystery Channel. We need to solve this mystery. So revenue is growing. That's very good. Revenue growth means a business is strong. They're getting more customers. The customers they have like the product, so they buy more of the product. Heck, they're buying more of the product. So that revenue growth to me is a barometer of the health of the business. It's a good business based on that factor. But we got to look at other factors, take that all into account. When we look at cash flow, do they cash flow? Do they produce cash flow? In trailing 12 months, they produced $665 million free cash flow. It's not a very high cash flow generating company. Okay, 665. Balance sheet. They have 3 billion in cash and short-term investments. Debt. Total debt 2.6 billion. So they have more cash than debt. So in my method of looking at a company, they have net zero debt. They can pay off debt immediately. So it's a strong balance sheet. Strong balance sheet. So 665 billion, it's a growth company. If I multiplied that times 30, I get to about 20 billion of value. It's still not up to 30 billion dollars. So let's do the valuation model on this guy and see how far we are from this company. Now I have a number of healthcare investments, so I can compare these guys to United Therapeutics. United Therapeutics is good investment. I made money on the United Therapeutics, and I think they're going to be valued a lot more in 5 years. So I'm glad I made that investment. Now I'm not going to talk about United Therapeutics. I'm going to talk about DXCM because we need to solve this mystery of why the stock market has discounted this company by 42% in one day. Why? It's like, dudes, that's like almost half the business, half the value of the market cap got thrown out the window. Why was it thrown out the window? So it's trailing 12 months is $665 million of free cash flow. Now, this is a high growth business, right? So I'm going to grow it at 25% because a couple of things are happening. Now, I've covered Dexcom for 10 years. Okay. I've known of them for 10 years. And there's there's a lot of decisions that I'm going to make as I analyze companies. And I see Brian, hey, I appreciate you joining. I'm going to look at INDV. And is this Brian that told me about pump? 'Cause, I like what you're suggesting, man. You suggested pump this weekend, and then previous weekend you suggested BTBT. Please put in the comments. Hear that, Brian. All right, so back to talking about Dexcom. So Dexcom, oh, got the symbol wrong. So I've known a Dexcom for the last 10 years, and the reason for it is I'm in Southern California. San Diego's, go down the highway with no traffic. 45 minutes an hour from where Dexcom is located. This is like a really neat success story. I like neat success stories where millions of people benefit, and that's the case with Dexcom. Millions of people with diabetes are now able to live a better life. Oh, that's good. That's good. That's no problem. And I think so. Okay, so based on a growth rate of 25% for the first 4 years, and then a growth rate of 5%, which is a high growth rate for terminal value. The current based on a 9% discount rate. Now, Dexcom has a good balance sheet, but they're still kind of a small to medium-sized business. It's not Apple. It's not Microsoft. Apple, Microsoft might get a 7.5. These guys are going to get a 9 for me because they're just smaller, a little more risk. You saw their stock go down by 42% in one day. So the value of all those cash flows is $25 billion. Cash on the balance sheet was 3.2 or so. All right. Sorry for clearing my throat, everybody. As you can tell, I am not a professional disc jockey. I am just a guy having fun analyzing companies. I apologize for clearing my throat. It might sound terrible on your side. All right, so cash equivalent, $3.1 billion. Let's take a look at uh, where's our total debt? Am I looking in the right place? Balance sheet. Where's my total debt? Here we go. Return debt. Here we go. Total debt, 2.6 billion. So 2, 4. We have we have 400 million shares outstanding. So, based on the cash flow forecast that I put together with the growth rate that I put on there, I believe the stock price is really valued at $64 a share. The market pricing it at $74 a share. So it's being priced at a premium of 13%. Their earnings per share, let's take a look at that. Analysts think it's 45% discount and 17 analysts cover it. Okay. So it's not like just one analyst is saying that. And $1.74, and it's expected to grow nicely. Okay, very good. And I believe those numbers. This is an industry people are not going to cure their diabetes. They're going to continue to need their product. Now, their PE, they're a growth company. They're in the right industry for me, so I'm going 36. Growth rate's going to be 10. Analysts say 20% roughly. I don't. I go with my own growth rate because they just suffered a 42% decrease in stock price. A lot of things could surprise this company. I'm going with 10%, even though I'm giving them a very favorable PE. But the stock price that I calculate based on earnings per share is 68. Stock price 74. Sold at a premium of 7%. So combined at premium 11%. So it's interesting the market brought the value of this company down so much, but it brought it down to almost a level that I value the company at. It's not an investment for me. I would give it the official pass on Dexcom. And it's just amazing that a company could go down 42%. Again, I've known of Dexcom for a long time. I was surprised by that decrement in price because it's a really good company. It's a really good business. They're doing something that is in demand. But there you go. Now, this lesson that the stock market just gave me did not cost me any money. So thank you, stock market, for the lesson. All right, we're going to look at. All right, good to see you, Brian. INDV, INDV. All right, let's take a look at INDV. This is a drug manufacturer, specialty and generic. Okay. Just a little background on my who I am. So I graduated in accounting. It was a very good education because now I can analyze companies. But I worked at a couple of companies. One of them was a pharmaceutical company. So I got to know how we do drug discovery and go through the whole FDA process, manufacturing appropriately, making product, selling it. We even had animal testing. I know that could be a really negative topic, but we were a full pharmaceutical. And I want to say that just to share with you that when I look at a pharmaceutical company, I use my life experience. In some cases, those experiences serve me to be able to be an investor in a sector. So when I look at a healthcare company, I have that as an experience, as well as having been an investor in pharmaceutical companies for a long time. So let's get into NDVR. All right. So people that have opioid use disorder are going to rely on this company. That became a huge problem. I'm going to read silently. Sorry. So these guys do pharmaceutical, so substance abuse disorders and other serious mental illnesses. Okay. So they're helping people. I mean, the opioid crisis was it was very big and it was very destructive, and that was not good. So we have the website isn't great about describing their products. The products. So I guess I'll answer the questions. North America. I guess based on where I'm located, they can only advertise or market certain drugs. So injection. So these are their drugs, and they're helping with I guess people that have become addicted to opioids and maybe some mental health conditions that people have. Make drugs in that area. Okay, got it. Take a look at their financials, and I'm gonna look at their financials here just so that they line up a little easier. FYI, I look at the investor page twice a quarter for every company because there's other information there. But since I'm doing a live stream, I'm gonna make this as easy to present. It's easier on you, I hope. Let's take a look. Now look at this. This is beautiful. Okay, growth, 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 growth. They're a small business compared to an Eli Lilly or a big massive pharmaceutical company. I like that they pick their lane. Hey, we're gonna help with substance abuse. We're gonna help with mental illness. That's gonna be where we are gonna be really good at. All right, very good. I like that. I like the growth. This means their product is being used effectively by patients. That means they're getting more patients. This means that they're going in the right direction. Were they profitable? They were not profitable in the trailing 12 months. They were slightly profitable in 23, profitable in 21, but unprofitable in 22. Look at the quarterly. The quarterly shows the most recent quarter didn't grow as much as the others. That might be interesting, and they did lose some money. So what happened in that? So this is where their losses came from in the most recent quarter. So let's take a look at their earnings real quick because the last quarter created some bad news. Um, where is the bad news? Okay, so Q2 2024 results in line with updated guidance. So they have a buyback, that's positive. Okay. So they're doing an expected settlement of opioid litigation. So these guys have some type of legal um, issue that they're trying to resolve. All right. So when we look at the quarter, this is Q and this is the half, right? So here's where they didn't have as much growth. Now, this loss may be related to this opioid litigation. We're going to look at the income statement and see if they're in accounting, they follow generally accepted accounting principles, GAAP. In business, to commit to the discipline of being conservative when you issue out financials, if you think you're going to pay out a judgment due to litigation, you take loss. That's the conservatism principle of generally accepted accounting principles. There's my accounting education coming into the field. All right. So, so I see that they were growing. I want to get to the financials. So guidance, so revenue, so net revenue is going to be between 1.15 and 1.2. I'm going to say they're going to be about 1 billion, yes, 1 billion to 100 million. It's going to be their top line revenue for the year. All right. And hopefully they show me a financial statement here. Okay. Income statement. So we got net revenues. Selling and administrative is a lot higher. So you see how it went from last year, they spent 133 million. They spent 311 million. So notes are down here. So we'll look at that. We're going to look at the details behind this line, which was causing a good part of that loss. Yeah. So that's where the money was lost. So 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 this income statement that they put in their earnings announcement is not detailed enough. Let's see if they did their SEC filing. I'll be able to get to a good income statement there. We're digging deep. We're digging deep on this one. Okay, so 6K. All right, you're not making it easy on me. So let's go with forms. So I'm looking for a 10K, and these guys are saying they have 6Ks. Well, that's not good. Let's take a look at something else they offered, which was hang in there with me, everybody. Just trying to get to the details on the income statement. Hopefully, they show me the details so I can understand why did their selling expenses go up so much. So, okay. Here it is. So Operating expenses driven by legal settlements. Okay. Now, what would be helpful, right? As a stockholder, there needs to be a partnership with the company and the stockholder. Give me more details. Show me how much money is going to be paid for this settlement. If you look at like 3M, which is a respected company, they had litigation and they were very specific. Like, hey, this is what it could cost us. This is how much we're going to pay. And then an investor could look at it and say, okay, I'm going to take that into account. And then other businesses that have gone through litigation, that's just the best way to do it. I'm kind of flying in here very fast, so I'm not going to make a comment of, "Well, these guys aren't doing it well enough." I would just make sure that they make it easier. Like, "Guys, you're making it a little bit hard." Maybe it's me, so I'm not gonna make a judgment call on that, but I would just say you need to be in partnership with stockholders. Alright, enough complaining. Let's get back to the analysis. So, most of that expense is related to their litigation expense, is gonna be an observation I'm making that needs to be verified, okay? I think I'm gonna try to move on because I don't wanna keep you guys too much longer. So let's keep rolling. July, they moved from the London Stock Exchange to the NASDAQ. Okay, good. Where are these guys located? So these guys are gonna be located in Virginia. Nice. I visited Virginia in August of 23. Beautiful place. Checked out some Civil War historical sites. Food was good. People are cool. Virginia, we got a lot going for you. Okay, so we got that. And the suburbs around DC are just doing great. Their economy is booming. So that was interesting. All right, so let's get into our valuation. We got all right, we're right in the heart of healthcare. This is another company I like. I'm not an investor yet, but Harmony. Some of these healthcare, small cap healthcare companies, like you're seeing here, great growth rate, making money, generating free cash. I like seeing that in these young healthcare. They focus, a market where they have patents which keep competitors out. It's a lot of good stuff. Okay, these are just smaller, so I'm gonna go 12%. They also have litigation involved, so yeah, let's go 12%. Increase the, yield that we're gonna get, the return, because we deserve it. We're taking a higher risk, man. Alright, so we got, they were announcing so trailing 12 months of free cash flow is so this one's negative. Could've sworn in their specifics here. Oh, that's the balance sheet. So that's the balance sheet. Negative free cash flow here. Looking at the quarterly, last quarter was 84,000,000. It was negative the quarter before, and very negative at the end of 23. They don't have a very good track record on cash flow. So let me take a look. See how we're going positive, negative, positive, negative, negative, negative. So this thing isn't going to cash flow. I don't see a consistent trend of generating cash. So my free cash flow valuation method is not going to apply. I can't use it. I can't take bad data and come out with a result that I depend on. Let's look at earnings per share. Analysts, there's two of them, and they believe one believes it's worth $24 a share, one believes $22 a share. One of them is a pretty respected guy, Piper Sandler. I don't follow analysts, recommendations. I think it's interesting to see. I do my own valuation, but it's interesting to see what they think. So the reason that you have a positive earnings per share, that I just showed you that based on GAAP, you have a negative earnings per share. Is generally accepted accounting principles is how they're supposed to report to the street. But investors know that I'm going to extrapolate some of that stuff that generally accepted accounting principles made them put in there that really isn't a part of their business. It is part of their business, but it's not going to affect their ongoing operations. And that's why you see a positive earnings per share. So we are at $1.87. This is a growth business. Looks good. Do I go? I'm going to go 30 on this. I don't know them that well. Growth rate, 10% is cool. So 186. 30%, 62. So, damn, I get such high valuation. I do so they don't cash flow. 87 a share. I think because earnings per share. Yeah, the market's giving a PE that's super low, like ridiculously low. If a business is growing, maybe the market's thinking, and did we look at their balance sheet? So cash 379. What's their debt? Total debt two. So they don't really have debt. They could pay off debt completely. Now, how big is this judgment potentially? So that's a question that we need to answer before we can proceed. If the judgment's going to be like, oh, it's going to be a $200 million judgment, okay, that's not no problem. But if, oh yeah, this is going to be a potentially a $25 billion judgment, like, oh, okay, game over. I can't touch this. This is a tiny company. So I think that needs to be addressed based on earnings per share. This is highly discounted. They don't cash flow. So for me, it's a pass. And there's a couple reasons for it. Is um, I have plenty of healthcare companies that they have their stuff together, man. Catalyst Pharma, killing it, growing, cash flow, earnings per share. They're a pharmaceutical company. Harmony, killing it. United, killing it. So why am I going to go if I have really good choices in healthcare? I pass on this guy because like there's too many skeletons in the closet. There are some question marks. Can somebody make a lot of money on that? Potentially. I want to make a lot of money every year, and I make it by buying a company that's going to make me money for the next 5 years. I think United Therapeutics is going to do that for me. Catalyst is going to do that. So I'm good. So that's why I would be passing on this company. Although it was interesting, it just has a little too much negative stuff, and it doesn't have any cash. And if you look at pharmaceutical companies, Eli Lilly, and it's Eli Lilly's, it's these guys are the most valuable company in the space, and they're doing the weight loss drug, right? So they're just killing it. They're already massive and they're growing really nicely. When you look at their cash flow, pharmaceutical companies, one of the reasons I like pharmaceutical companies, these guys are down on cash flow. You might be investing a lot, but what I was expecting was you would see high cash flow. That's why I like these pharmaceutical. Eli Lilly, I've never been an investor because they don't have the kind of cash flow I'm looking for, but they have the top line growth that the market really likes. The market really likes what they're doing with weight loss, and that's what I've got to say about what was it in INDV in DBR? If I'm saying it right. All right, next one, BNTX. BNTX. Staying in healthcare, staying in biotech. I love biotech, man. Like United Therapeutics, it like made my head explode in a positive. United Therapeutics is they're doing organ transplant xeniology. What does that mean? They are growing organs in a lab, transplanted to a human, and they already have they transplant animal organs like from pigs, to humans, like heart valves and stuff. They've been doing that for a while. They've been transplanting machines like artificial hearts into people long time, and of course, person to person. Some person expires and harvest those organs and move them over to a person that really needs them before they die. Well, the scientists at United Therapeutics, first, they're freaking smart. They already have a business that does these drugs for rare diseases that really work, lots of profit and cash flow. But they're going after this organ transplant genealogy business, and they're getting somewhere with it. And can you imagine the list of people that need a liver or an organ that are sitting there just you know waiting, hopefully to get a transplant? And this company started producing them that worked. And maybe this is an elderly person, so if they can get another 10 years out of their life, they're very happy. I just think it's a win-win. Like the public would need has to be safe, but the public has to win. The company wins, everybody wins, and it's pretty damn amazing what they're doing. Let's see what these guys are doing. This is BioNTech. BioNTech. Let's take a look at their website because I want to kind of get my head around what do they do. This is an out of country stock? Yeah, this is a German company, right? DE is that Deutschland? Yeah. I think this is a German company. Is this the company that partnered with Pfizer? So, BioNTech, okay, okay. So these guys are in doing discovery for oncology, infectious diseases. I believe, yeah. This is the company that had a lot of the smarts behind what I believe, these guys partnered with Pfizer, and Pfizer took their, science and put it into market, and they came out with their, vaccines for COVID. Let me confirm that because that's what I think is going on, but I wanna make sure that. So BioNTech. Here it is. Okay, so this is it. Alright, cool. So Pfizer, big pharmaceutical company, uh, this is a small company. They're like, "Hey, we got potentially a vaccine for COVID. Obviously, the world needed it. Pfizer, you have the capacity to manufacture and distribute and get it out to the world. Let's partner. Win win." Okay. So now I know what we're talking about. Let's get back into fundamentals. So you can see that, hey, we're just this little company. Cool. Oh, by the way, we discovered a effective vaccine for COVID. So we went from $482 million and we generated $19 billion of revenue in 1 year. Look at us. We grew 3,834%. Wow. Why can't you sustain that? And then in 22, they were 17.3. Now they're back down to 3.8, 2.6. Okay. So obviously, this was a stock that took off and then came back down, understandably, because COVID is now uh, somewhat controlled. And I'm not a scientist, but that's my observation. All right. So we got that. Now, if we look at their most current year, 23, they are profitable. Look at their cash flow. What's their, uh, 21 billion. Okay, cash flow. So they cash flow very nicely. Yeah, these guys are gonna value quite nicely. So now I'm very curious to see balance sheet. They have $17.3 billion of cash, and they have almost no. This is a $21 billion company with s $17 billion in cash. Really, you're paying $4 billion for the company, not 21, because it's like buying a car that has a bag of money in the back seat and you paid 30,000 for the car, but there's 20,000 in the back seat, and it comes with the car. And it's legit money. It's not like they just robbed the bank and you're gonna go to prison. It's just, whatever. There's a bag in the back seat and has 20,000. Well, the net price of that car is 10 grand because you buy the car for 30, you get 20 grand in the back seat. Your price of the car is 10 grand. These guys, the BioNTech car is priced at 21 billion, but there's 17 billion in the back seat. So you're paying 4 billion for the. That's why I look at cash and I look at debt. Is because you can see my logic there, I hope. And, let's take a closer look. So I know these guys are gonna value very high. It's interesting. Now, where are they making their money? The question I would wanna answer is, where are they making money now? Okay, I get the whole COVID thing. You guys, FYI, their credibility in the world has gone up, right? Everybody knows who these guys are, especially in the industry. They're like, "All right, we know these guys solved the problem that needed solving very quickly, so they're probably really smart. Let's partner with them." So they're probably getting a lot of opportunities now. Investors, I wanna look at their actual financials, and I'm always gonna translate German. So, No SEC filing about. Oh, I think because 'cause they're a foreign company, they go with a 20F, I believe. Okay, so I'm gonna go with annual report. Now, this is a little dated, but it's probably gonna give me the answers I'm looking for. Yeah, it's gonna be a long report. I don't know if I'm gonna get there, so I'm gonna take a couple stabs at this. Here we go. Oh man, rather be lucky than good. Okay, so commercial revenues, very good. Research and development, okay, that's fine. You look at their costs, like they have this much revenue, and their cost is actually their cost should be negative. So research and development, they continue to put money in there. So they have operating income of 690. Okay, good. So this looks really good, very promising. This is a stock that I would want to analyze even further, and spend a couple hours on. And I'm not going to hold you guys on for a couple hours, but there's a couple of questions that I have that need to be answered, which is what are the drugs, what are the treatments, right? Kind of align those two. And then what I don't want is investing in a company where commercial revenues are out there, but if COVID is behind us and there's no more revenue related to COVID, then that's going to go away. But overall, if I'm getting a company that is generating um, good cash flow, right? If they're generating 2.6 billion of cash flow, I just said the net price for this company is like 4 billion. This is like no brainer territory. It's like there's a lot of value. Now, I don't own any companies in Germany. I'm not opposed to owning companies, but I also want to look at okay, if I buy a German company, what does that mean? Do I have like a list of questions that I need to answer, and I need a couple hours to kind of get my head around. So it's a great idea. It's not a buy, it's not a sell for me, it's not a pass. It's a, "Hey, there's a lot of value here. I need to research and analyze this." Thanks, Brian. I don't know what you do, but you find interesting companies, man. And then MRNA. Let's look at MRNA. Moderna, you know who they are. This was the other company that had a vaccine. Like in the US, we had Moderna, we had Pfizer. And I know around the world, there was other vaccine, like AstraZeneca provided their vaccine, and a couple of other pharmaceutical companies came out with a vaccine. I know that when I was in Mexico City, they talked about the Chinese came out with a vaccine. I believe the Russians came out with a vaccine. But those vaccines, according to them, not my opinion, they nobody wanted to take those. They didn't believe in them. They wanted to take Moderna or Pfizer. And all right, Moderna. Oh, don't you just love shareholder lawsuits? What do you mean the stock price went down? We're going to sue you. Um, so obviously, in the height of COVID, these guys found a solution, and they're like, "Oh, we're going to price you like you had a solution to COVID." Yeah. Well, what do you mean COVID's not going to be around forever? Yeah, we're over it. Okay, so revenues are down. They're a $31 billion company, and so their revenues, right? Oh my god, they're a $60 million company. Hey, we discovered COVID, 17 billion, 18 billion. Okay, 22,000, 2,200, excuse me, 2,200 net growth. Awesome. Okay, so these guys are going to be in the same category as BioNTech. Now, one thing I would say, let me get to this one, and then I'm going to have kind of some concluding thoughts on this. So, they're losing money. Not sure. Cash flow. What's their market cap? 30 billion. Start with the balance sheet. How much cash do they have? They have 8.5 billion in cash. They have 1.2, 1.3 billion in debt. So let's call it $7 billion of cash. So their market cap's 31.6. Subtract 7 billion from that. It's really being sold at 24.6 billion in price. If we net those two out, if we look at free cash flow, it's negative. And the reasons for that, if we look at the cash from operations, negative 3 billion. So they had a change. Yeah. So they came in with a loss. And the statement of cash flows basically takes the income statement and takes out non-cash lines or events and says, "You truly made this much cash in the period." And what this is telling me is they actually decremented their cash by 3 billion in 1 year. That's a lot of cash going away. In the trailing 12 months, it looks like it might be, yeah, it's kind of persisting that they have a negative operating cash. So this is a area of concern. What's going on here? Gotta figure that one out. Can't proceed until I figure this out. Okay. So I would really look at the statement of cash flows and understand, okay, is this temporary? What kind of run rate are we gonna have from there? What would be the best forecast? The statement of cash flows didn't look good. Balance sheet looked great. The revenue looks okay. The company, I understand who they are. I want to understand, okay, now that COVID's done, right? And expect that we're gonna get a pandemic in the near term again. What other businesses are they in? And what is that gonna be about? Now, to kind of conclude both BioNTech and Moderna, I'm an investor in Pfizer. And the reason I invested in Pfizer is sometimes I can't walk and chew gum. So these guys, to me, are a very good proposition. They pay a good dividend. I'm not a dividend investor. It's just a positive when you see that. The market really recognizes them. And my whole story behind Pfizer is obviously they did great. Like, they were a $40 billion company before COVID. COVID hit, they doubled their revenues, and now they're back down to 50 billion in 23. 58 billion. That's substantially more than 2019. They took in so much cash during COVID years. And the market, I don't know that the market really understands that, but look at this free cash flow. They raked in close to $30 billion of cash in 21, 26 billion in cash. That's 55, 56 billion in cash. And they continue to rake in more cash. Dude, you gotta get a bigger rake. So I'm like, holy smokes, these guys generate cash. And their business is growing. Now, the hardest thing they had going for them is when you have these compares, and you're like, "Oh, I'm comparing against 100 million in revenue." Okay, cool. So your business dropped 41%. Oh, market doesn't like that. But really, that's the wrong comparison. This is like a one-time event, right? Which was a positive event. I showed you how much cash they generated. So I'm seeing this in a lot of businesses. Zim being another business that's seeing this type of stock, uh, graph where during COVID, they were like, "Man, we're so much money." And they fell off a cliff, but they had a lot of value, so I bought it. Now I'm up 80% on Zim. I'm not up that much on Visor, but when you kind of take this data out, this data does not repeat. Take this out. And high level, is the business stronger, better than 2019? Yes. Bigger. They have a ton of cash on the balance sheet. I mean, these guys have so much flipping cash on the balance sheet, it's ridiculous. Okay, that looks good. They continue to produce free cash flow. Looks really good. Now let's take a look at the stock price. So in 19, they were a $34 stock. Now they have a surplus of like $40 billion cash. Well, that should mean something. You mean to tell me that before COVID, they were worth $34 a share? After COVID, with a ton of cash, they acquired a business that does this treatment for cancer. They have really strong patents with that business. It has already a good run rate of revenue, profit. So I think this is a $50 stock all day long, could be more. And I started buying into Pfizer, and it's taking into account the big being one of the COVID vaccine providers. And I probably wouldn't double up on BioNTech or Moderna because I've already got one player in the space. Okay? And I think I'm picking a player that's historically one of the better players. That's why. So I'm kind of giving you an opinion on Moderna. I think Moderna is interesting. If you don't own a Pfizer like I do, maybe Moderna is a really interesting investment. But you see these guys, they were back here, $34 stock, and then they rock and rolled up to $70, 70% increase from that point. If you look at the trough, which would have been impossible, pick that moment to buy, it went up substantially. But the market, the stock market's so interesting. Stock market say, "Oh, yeah, Pfizer, you're terrible. We're gonna discount you by 57%." Really? Why? Because you can't repeat the COVID year, 100 billion in revenue. Yeah, because it was a pandemic. But I got all that cash on the balance sheet. I don't care. I acquired a business that does, treatments for, these cancers, and we're gonna have an increase of, like, $5 billion to our top line. Don't care. Don't care, man. I just don't care about that. But if you buy at the right times, you'll make some money. So I'm buying Pfizer. And that's why I probably wouldn't buy Moderna. I probably wouldn't buy BioNTech. Although I'm gonna analyze BioNTech because that's too much interesting stuff going on in one place. I may end up buying BioNTech. I don't know. I don't know. I may not be able to help myself. There might be too much value. Now, we just hit, 2 hours to open the stock market. Let's take a look at where we're at with the stock market. Nasdaq's down. Oh, what the heck's going on, man? I'm not gonna make a lot of money again like I did last week or the week before, but I'm not gonna lose a lot of money like I did a month ago. So, just give and a take. Let's go by industry, sectors. So energy still leading the pack, materials, technology, consumer discretionary, consumer services. Oh, okay. Healthcare is back in the green. Interesting how we're starting the week. This might tell us I'm not a forecaster, okay? But I watch the market every single day. I love it, and my best guess is, if we get off on the negative foot, this could be the trend for the week. We'll see. We'll see what happens. It'll be interesting to follow. This is why I don't trade in the first half hour. If you recall, in the first half hour of trading, you saw stock prices, especially on the Russell, up 3%, and now it's just up 0.47%. You see the Nasdaq was pretty much flat, and now it's 1.83%. So the market didn't kind of show us what it was going to do in the first half hour. Now we're into what, an hour and a half of trading. It's beginning to tell us what today's going to be about. And a couple of days would tell me what the week's about and how I can use the momentum of the market in my favor to buy into companies. So it was an interesting turn of events. All right, everybody. Special thanks to Stonks. Be aware you want to be on the Stonks live stream, 12 p.m. Pacific, 3 p.m. Eastern on Wednesday. They're going to give away 10 grand. Whoo, baby. If you could pick the stock price for NVIDIA, I think 30 minutes after markets close, um, and whoever guesses closest is going to get the lion's share of 10 grand. Oh, man, that's a lot of money. Um, I know I'm going to be playing, and we'll see where NVIDIA trades on Wednesday. I think the NVIDIA earnings is it's like a high prize fight, two legendary boxers, Super Bowl, World Series Game 7 kind of attention. Um, I know kind of like the internet's gonna slow down or break on 1 p.m. Pacific on Wednesday when everybody's clicking the refresh button on the NVIDIA investor page. It's gonna be interesting to watch that. I'm gonna be glued to it, and I'm gonna be watching, see what happens, and it'll be really fun. So just a reminder, you wanna be on the Stonks website on Wednesday. I don't think I needed to remind anybody, but maybe somebody that's viewing didn't hear about it. And every day they have, giveaways. I know I'm gonna attend today. I don't know what they are giving away today. This is free money, man. And it's fun. It's fun to say, "Hey, what's" like today's is gonna be Solana, which is a cryptocurrency, and, I'm not sure what cryptocurrencies are gonna do. Cryptocurrencies are down, and that makes sense. They tend to move with the Nasdaq. The Nasdaq's down. What's Solana doing? What's it might is it Sol is Cardano? I don't have Solana up here, but I have to go to my Coinbase account, and I'm not gonna do that with an audience, and take a look at that coin, but, man, I'm probably gonna guess, I don't know. I'm gonna have to make my decision around 12:30 and see where the market's at. If I had to make a guess right now, I'd probably say Solana would be down after hours, but it's too early to tell. We'll see in about an hour. We'll see in about, 4 hours, excuse me. All right, cool, man. So, everybody, happy Monday. Let's, uh let's see where the market trades. It's gonna be really interesting to see where it trades, and, it's gonna be super interesting to see the NVIDIA earnings. Um, and we'll see where GDP lands on Thursday. That's gonna be an event worth, keeping an eye on, and we'll see what happens. I'm gonna do this again tomorrow. I'm gonna open the stock market each day this week on stocks. Looks like I got 24 viewers. Thanks so much for tuning in. Appreciate it. If you wanna follow me, that'd be awesome, and, I'd really appreciate that, and, I'll be here tomorrow. Hopefully, I see a lot of you. Thanks for the good questions, good stocks to look at, and let me wish you good luck, investing. Take care. Bye.